My name is Greg Ingram. I'm president of the Lincoln Institute of Land Policy. I want to introduce the speakers today and the topic. Our speakers are Jim Follain and Seth Giertz. Jim is a person who has worked in the ivory tower and also in the marbled halls of Washington and has substantial scar tissue from both experiences.
That's right.
I think probably a bit wiser for it. He has done a lot of work in urban economics and in housing analysis. In addition to being an academic, he spent some time working for Fannie Mae and other housing agencies in Washington and some consulting firms looking at issues dealing with the housing market and the housing crisis. He was in the belly of the beast before the recession and has sort of lived through it and has been contemplating what he's learned from that subsequently. So he is a very experienced hand at this business, very knowledgeable about the data, and has sort of lived through the catastrophe at the policy level. Seth is an assistant professor at the University of Nebraska. He has been working in the area of housing for quite some time. He's worked at CBO and at a presidential commission on tax reform, federal tax reform. So he's also been back and forth between the ivory and the marble in this business. So this is a very empirical paper. The title is on the board up here. I want to make a comment about this. I've looked at this paper. We've been talking about it. It's the first phase of at least a two-phase piece of analysis. And I want to share with you my takeaway from this paper, and which I find very interesting and happily surprising. But I want to start by saying one of the things that I have noticed professionally for a very long time, it's a bit of a cartoon about the urban economist on the one hand and the urban planner on the other hand. And the urban economist has a kind of view and predilection that involves looking across cities and looking for common elements in the urban experience. And so urban economists are taken and bewitched by the notion that there are a lot of similarities across cities. Urban planners are taken and bewitched by the notion that every city is different. And this notion that cities are very similar and every city is different has the paradox associated with it that both people are right, both professions are correct. And what's interesting about this paper, to me, is this paper in some sense embodies those results. And that is what you're going to see in the results are, there's a set of findings in here of remarkably similar, what I'll call behavioral coefficients across different categories of cities. He's done stratifications in different ways, and the behavioral aspects are very similar. At the same time, the fixed effects at the city level are dramatically different. So we have a result here where there's some underlying behavioral consistency across cities, but profound differences in housing markets across cities that show up in these fixed effects. The second phase of this research is essentially going to be to sort of winkle away at the fixed effects and try and introduce additional variables at the city level or at the metropolitan level to try and erode these, see if we can understand more about these fixed effects. But that's not what this paper is about. This paper is about the first set of results. The other remarkable thing about this paper, it's not remarkable, it's a sort of fact of life in some sense now, but for those of us who have been in this business for a while, what is remarkable about doing empirical research is how much data there are. So this is a paper that's looking at data from over 350 metropolitan areas in the United States, basically from the mid-70s to 1910. So what you have here is a really big panel data set. These results are using annual data. but it's essentially looking at housing market behavior over essentially a 30-year period in the U.S., culminating in the 2008 debacle. So it's a very data-intensive exercise. It takes a long view. It's a set of interesting and provocative results. So with that, to whet your interest and get you to raise your head from engaging in your lunch and pay attention to things, let me introduce Jim and do most of the speaking. Seth is going to answer all the hard questions.
It's a plan. Thank you, Greg.
Join me in welcoming you, Jim.
Thank you very much.
Good.
I started coming here as an assistant professor in the late 70s and just have some phenomenal professional experiences and friendships. Roy Ball, Dan Holland, Richard Bird, the list goes on and on and on. And just feel very fortunate to be able to work with Greg again. Okay, the title, a look at house price bubbles, 1980 to 2010, and then this the role of local market conditions. So we kind of snuck in a story that I'd like to try to tell to you today. Give you a sense of what we mean by bubbles, and this is a definition that constantly gets refined in different groups that I talk to, but essentially it's some sort of persistent, unsustainable departure of the level of prices, in this case housing, from what the fundamentals might suggest. So that's a generic definition. Then the argument is, what are the fundamentals? How do you measure that kind of stuff? But that, I think, is a pretty generic definition. And bubble detection is inherently difficult. I heard a story recently, what's the difference between economists and weathermen? Both are lousy predictors, but at least the day after it happened, the weathermen can agree on what happened. Economists are still trying to talk that through. And a part of this story that reflects on my life the last 10 plus years in Washington has to do with the difficulty of defining extreme events. I've done a lot of work on capital for banks and Freddie and Fannie and things of that sort. Stress scenarios, that's kind of the story. Defining what that stress scenario might be and then convincing people to take it seriously, very difficult. I've written something called Black Swan Blindness that talks about the complexity. It relates to a lot of arguments going on around the country today. Fracking, coal fracking in this part of the country. How risky is it really? And so it's not only hard to do, but then convincing folks that there's something really to worry about and what that extreme scenario might look like. They're very complicated conversations. Now, a big part of our story is that if you're going to look at house price bubbles in the United States, they didn't just start this time. We've had a number of them over the last 30 years, different places in the country. But I think what we want to leave you with is how important local market conditions are. And I'm going to give you a little more motivation to that in a second. And then pick up on a point that Greg raised about there's also this similarity that we find. And we found it surprising because we've done some previous work looking, one of the big explanations that people talk about for this most recent bubble is that there was a regime shift. The kind of equations that are estimated using data prior to the bubble look really different than now. And we found a lot of stability over time and among markets in some of these key coefficients. So it's kind of a dual. On the one hand, we're going to talk about the importance of local market conditions. On the other hand, recognize there's some stability here that I think ought to be taken seriously. Now, this topic can be motivated in many, many ways. Here's one that we picked and see whether this works for you, and I'll give you a little bit of the origin of it. Monetary policy affects interest rates, things of that sort. And I suppose they're going to come out with their announcement this afternoon about what their most recent story is. And last spring, Alan Greenspan came out with his analysis of the crisis. And one part of this paper, through the Brookings Institution in the financial crisis, one part of his story was it wasn't my fault. I mean, it was kind of there's John Taylor had been writing a lot about how aggressive monetary policy, loose monetary policy in the early 80s fueled the crisis. And so Greenspan wrote this paper, and he ran this regression. And the dependent variable was level of house prices at the national economy. And he had a couple of independent variables, long rates and short rates, interest rates. And long rates were more highly correlated, so he said, aha, it wasn't me, because I was just controlling short rates. And I read that. I was teaching a course at the University of Albany. I just disappointed in that kind of analysis. And one of the implications of this work, I think, is this notion that we have some sort of homogeneous housing market, national housing market, I think is a real problem for policy. There are wide variations. Interest rates matter. They matter the same. They matter in San Antonio as they do in Boston, but the impacts will be different because circumstances in those local market conditions are different. And that's kind of a theme that we want to try to emphasize. Monetary policy per se, probably pretty weak tool in terms of combating house price bubbles. You need to go more granular. And there's a new term now that's being touted at the Fed and other places called macro-prudential policies. It's not just monetary policy, you need to do more. So I'm kind of hoping we're clinging the bell for paying more attention to local market conditions and not to rely just on shifting around interest rates. This is something I wrote in 2005. We were doing due diligence models for building models for Wall Street to kind of help them decide which loans to buy, which ones not to buy. And I built a model, worked with a colleague, Mike Sklar's. And what we were trying to do is say, listen, California is different than Omaha. I keep thinking Omaha, but Nebraska. There were things happening in the housing market that I think increased the chances that there'd be some steep decline. So we took those results, we estimated our own house price models and things of that sort, and then tried to show what the implications were for mortgage rates. So if you're more concerned about risk of a downturn in California, you should raise the interest rate. And what this chart shows is what we call the credit risk spread. So a typical mortgage might start with a 10-year Treasury at 4%. You add a couple of percent for interest rate risk, you're up to about 6%. And then anything on top of that is essentially an add-on for the credit risk, the likelihood that the person is going to default. And when in this bank capital debate and things of that sort, there are two parts of the pricing. One has to do with what's going to happen, what's kind of the average result. Those are expected losses from default. Then the second part is the catastrophic or the extreme. What happens if there's a really serious decline? How much would be lost to the bank? And that's capital. That's how much they have to put away. They have to put that away in a very safe asset. So Warren Buffett is in the business of doing this for hurricanes. He was originally. So that's all about catastrophic losses. So he had to estimate the likelihood of a serious hurricane, and then the damages of that hurricane, and then he had to put money away in really safe stuff, safe investments, because if a hurricane hit, he can't afford not to pay. Same kind of story with capital for banks. They have to put away that money, they invest it in low yielding but safe investments. And what this does is tries to show, okay, what if we try to capture the credit risk to a lender that took into account the possibility of those extreme events? What would it look like? This is in early '05, middle '05. We have a paper on this. So the 200 basis points. And at the bottom you got LA, Sacramento, a lot of those places in the sand states. And we were saying that the credit risk there was 200 plus basis points. That's per year. So you'd have an interest rate there of like 8.25%. And most of this is because there was this fear of a substantial decline. Then at the other extreme, I just pulled off some here. Kansas City, Missouri, relatively stable. Very low probability, based upon the work we did, of a real serious decline. And there the spread was like 60 basis points. So where this is going is if you're really worried about bubbles, you've got to treat the regions differently. You've got to have different policies one way or another. Franklin Raines, who was the chairman of the board of Fannie Mae for many years, used to talk about how mortgage insurance companies were really important in the mortgage business until the early 90s. Because if they saw a bubble happening, the private insurers would back out. And Fannie and Freddie were not allowed to buy loans without mortgage insurance if you had something more than an 80% loan-to-value ratio. So de facto, there was that kind of policy in place to slow down lending in the areas where there was a bubble. That went away for a long time. And I hope that's one kind of place that I hope our debate leads. I just mentioned one other paper that Seth and I did just before then. The government had a stress test scenario for Freddie and Fannie. And we went back and did some empirical work, and we concluded, there's a paper in Journal of Housing Economics in there, that, man, there was a lot of blindness. That it didn't change for 25 years. And we thought the evidence properly, at least as we understood it, properly interpreted, called for a stress scenario that was 50% higher. So that's kind of the context. It's about, we're talking about local market conditions and trying to get a handle on extreme scenarios, because they're very important too. So today I thought I'd talk a little bit about literature, the model, focus on the key results, and we're in the midst now of doing Act 2. We have a couple of different projects underway. We'd love your feedback on that as well. But questions, comments at any time. And I understand at the end there will be more formal time as well. But please, the only question I'm really uncomfortable with is if you ask me what's going to happen to your house price over the next year. I do get that question from time to time. So I don't know. I just okay, literature survey. So I recall when Greg and I were doing, starting out in the 70s, you could go to the library and pretty much read most of the stuff on your topic and kind of get a rough idea of what's going on. But no mas. If you do a Google on house price bubbles, you get like 1 million hits, right? And there's papers being written all over the world. We focused on so a literature survey today, to me, is almost a little bit about putting our paper in perspective. Where do we hope to kind of make a little bit of progress? Hardly a definitive. The number of papers on house price bubbles in Asia is just unbelievably large. I read a couple, but no way in the world would keep up with all of that. The part that we wanted to emphasize was parts of the debate on house price bubbles that are relevant to our paper. So one was the national versus MSA focus. I gave you an example of Greenspan using the national housing market. Many other people out there go to either groups of MSAs, or in the extreme, the stuff I was doing a few years back, every MSA would have its own equation, own set of parameters. That's the other extreme of the case. So we're kind of in the middle. That's what's going on here. Rent to value ratio. There were a number of papers written in the early 2000s that looked at rent relative to value. Edward Leamer did some fantastic work on this. He's at UCLA. And when the rent to value ratio gets really low, what are people thinking? They're thinking the house price expectations are going to be so large that it makes it worthwhile to make that investment. But it's kind of partly on the value of the services rent and partly on where you think house prices are going. So when the rent to value ratio started going down, it implied a future set of prices, that growth that would just off the charts in terms of our history. And so a lot of people use that as this kind of a guide to whether a bubble's coming. I think a lot of wonderful work. Alan Goodman, Tom Thibodeau did some really nice stuff. The problem that I have with that kind of stuff, and I've written about this myself, rent to value ratio is just one particular indicator. There's another thing that happened in the last few years, and that was enormous increase in uncertainty about where things are going. So the theory underlying the role of the rent to value ratio depends on both future expectations and the risk premium. They're both changing. So reliance on just that as an indicator struck me as somewhat narrow. So we wanted to go beyond, instead of imposing that as our key measure of a bubble, we wanted to have a more eclectic approach to that. Momentum. So Chip Case, Robert Shiller, those guys are my heroes these days. I think economists really tended to sell them short until the early, I didn't mean that literally in a finance sense, but until the early 2000s, and talking about expectations, irrational exuberance, and all that kind of stuff. And I think people are listening to them a lot more clearly. And what it tells you about a model, and what our model confirms, I think, is an enormous emphasis on the role of momentum. So when things get going in one direction for a while, they tend to keep going in that direction. When they turn around, they tend to go down the other way. So momentum, to me, is one way of capturing the great work that they've been doing. Focused on extreme events. I mentioned that already. And kind of a methodological story, the way we actually do this estimation. So economists typically in the late 70s and 80s and all through the early part of my career, you would specify a structural model. There'd be a supply and demand equation for owner-occupied housing, a supply and demand equation for renter-occupied housing, and you went to the data with that in mind, and you go estimate the parameters of those supply and demand equations, then you tell your story. And I did a lot of this stuff. Well, in the mid-90s, Seth and I were introduced to kind of a new wave of empirical work called vector error correction models. And what these are doing, they're being much less rigorous about what's exogenous and what's endogenous. It kind of said, listen, these variables, in our case, employment, income, and prices, they're all interrelated. It's not clear that one drives the other. They're interrelated. And it's a much more of a dynamic relationship. So a lot of wonderful econometrics were developed that allows you to estimate a model, and then you estimate it, and then you let the data tell you how, in fact, these variables do relate to one another. So we adopted this approach here, and I think we can give you the headline. There's some other papers out there that do this, including Michelle Dryman-Harder, who was a student of mine, classmate of Seth, who did some work on this years ago. So the way this model works, so you first try to specify an equation that explains what the level of prices should be as a function of the fundamentals, income, in our case, income per capita and employment, interest rates, and we also put in there the 10-year and 1-year Treasury rate. I'm not saying Mr. Greenspan's wrong to think that interest rates matter. It's just other things beside that matter. So we have those in there. And we also put in, turns out to be a really interesting angle for our paper, we put in MSA Fixed Effects. So the idea is that there's some constant term that varies by each of these 300 and some odd MSAs that we estimate. So that's kind of a punt. Yeah.
What does MSA stand for?
Oh, thank you. Metropolitan Statistical Area. So that's our data. So it's like, okay, thank you. Thank you. So first stage, you run the level of prices against these variables, and what you find in that regression is some sort of a disconnect. Prices seem to be a little high in some areas relative to what the fundamentals would predict. They seem to be a little lower in other areas. Those are kind of errors or residuals. That's a measure of how out of whack or in sync prices are with the fundamentals. In the second stage of this analysis, we take three equations, in this case employment, income per capita, and prices, house prices, and we look at models that explain how they relate to one another and how the lag prices affect employment and so forth. And we also include in there that residual from the first stage, so that the point of the residual is if prices are above what the fundamentals would say, then all else equal, the growth rate in house prices should be lower. If the price is way below where the fundamentals say it should be, then you might expect house price growth to be faster, all else equal. So it's basically a first level Beck equation where we get a measure of the bubble in some sense, and then we feed that into the second set of equations, which captures these ideas of momentum and things of that sort. I mentioned that one extreme is a national housing market. The other extreme is one equation per MSA. We, grand compromisers, we try a lot of different groups, broken out by population, broken out by whether there's been a growing or declining area. Ed Glazer and Joe Giertz have done some tremendous work over the last number of years that kind of distinguishes declining cities from growing cities. And we tried to do a little of that as well. I think we're going to do more of this next time. I'll just come back to that later. And then once we estimate the model, then if you just look at the coefficients of these by themselves, it's kind of hard to interpret. You really need to model, take into account the interaction among them. And if you really want to look at extreme scenarios, you, I think, benefit from simulation analysis. So what we estimate our model, and then we conduct simulations. We're shocking you with some set of error terms, and we're looking at what house prices are expected to do over the next 3 years. So we'll have 500 different possible outcomes, and some of those are extreme negative outcomes. So that's the part. So we estimate, and we do our simulation, do it for a lot of different groups, and we tell our story. I think that's probably enough on the model. The equations are in the paper. I'm just thinking that's not the, and even on the data, I think I'm just going to skip and go right to our story. So I'm going to just give you a few examples of the estimation. A little hard to see perhaps, but I'll try and blow it up. Let me show you this first one. Can you see that okay? Or I'm sure it's hard. I can barely see it here. But this one is the growth rate in real house prices. This is the growth rate in employment. This is the growth rate in income per capita. Because it's too hard to read through the numbers. That's not critical to the story. I just want to give you a sense of what we're doing. 3 equations. And the independent variables are all the same thing. So against house prices, we regress lags in house prices. We regress lags in employment, and we regress lags in income per capita. And this is for one particular group of MSAs for one particular time period. We do this for a lot. So we estimate the model for a lot of different groups. This table, someone, when I was here last year, suggested we needed some sort of a dashboard. And I love that term. And so we have this one table, which is a dashboard of our results. And I just want to focus on that point that Greg emphasized in the beginning. So we have to kind of sum up those coefficients in one way or another. And this column is estimating the model with data from 1980 through 1995. This is estimating the model from 1980 through 2000. And this is estimating the model through 2007. And so the one indicator of the model, what's happening to those lag coefficients on house prices. So this number here, 0.63, is telling us that the sum of those lag house price coefficients in that first model summed up to be about 0.63. In other words, if you have a 1% increase in past house prices, a big chunk of that, 63% in the simple case, would be you'd expect prices to be higher that next period by that amount. That's our measure of momentum. Good house prices lead to more house price growth. And when we estimated the model for a longer time period, got pretty much the same number. We estimate the model for an even long time period, you get pretty much the same number. Now what this table does, it's very large. We look at the similarity of those coefficients for different groups. We had like 9 or 10 different population groups and different time periods, and I was very surprised by the stability of those coefficients. Big table, but that's the point I wanted to kind of highlight about it. I'm going to shift this in just a little bit, but essentially we take our model, we estimate it, and then we project ahead what house prices will be. So in this first set here, we estimate the model with data through 1995, and then we project house prices over the next 3 years. So they're projected from 1996 to 1998. So we have to make some assumption about interest rates. They're pretty well flat. Otherwise, the model generates these estimates. And I've got this ranked in terms of the places where the crisis was most significant in the most recent crisis, 2008 to 10. So Stockton, California, Modesto, all out in California, kind of the Eastern Valley, are the places that have been hit the hardest by this. First row is Stockton, and I'm going to highlight the magnitudes of the differences in this 2008 to 10 period versus the others. 29% just about. Those are real house price declines over that 8 to 10 period from our model. So it was picking up something. Pretty substantial decline relative to, in the early part, if we estimated our model through 2000, it was showing Stockton as a pretty good bet going forward. In the through 95 or so, not much change one way or another. And if you go through this long table, you'll see, and I'll show you some graphs here in a second, but you will see the model really was suggesting something was gone awry down the road, but you're also going to see how far short the model was from what actually happened. When we wrote the paper, that's kind of what we did, and now what do we do with the results? So 3 questions I wanted to focus on. One is how accurate are the predictions? Does it really predict bubble bust? And then really look at a few places where the model was really off. This figure looks at the predictions of future house prices in that period 2008 to 10 versus what actually happened. So the blue part is our prediction, and down here I've got all the MSAs that we looked at, kind of some of them, kind of ranked in terms of the one that had the largest decline versus the one that had the least decline. So what you see is the model was predicting from down Stockton and Merced are over here, with predicting some pretty serious declines for those areas. Down here you have what actually happened. And all through here we have both numbers, actual versus predicted. So the story that we try to tell is that, wow, did a really cool job of picking up the ranking. If you're just interested in which place was going to get hit the hardest, the model did a pretty good job. But wow, did it miss the magnitudes in terms of the worst hit MSAs. Stockton, Merced, a lot of these places in the sand states, California, Arizona, Nevada, and Florida, what actually happened was much worse than this model predicted. But it picked up the rankings really well. The next one, talk a little bit about this. What really drove the predictions? We have our variables in there, and employment, income per capita, and prices. Those are the drivers. But there are different ways of kind of characterizing what really mattered. And I want to just show you a couple of things. So what we're looking at here, okay, take the predictions of our model for that 2008 to 10 period, or what really was causing those predictions. And so we put in some of the variables that mattered. I want to highlight one in particular. So lagged house prices mattered a lot. So on the way up, they mattered, but when they started going down, that momentum factor kicked in, and they were an important part of what happened. Employment with another, income per capita, teeth statistics very small, not that important. Employment and house price were really the key. But this is the teeth statistic, the one that really jumps out at you, I think, is that measure of the residual that I mentioned earlier. The more out of whack the level of house prices was in a particular MSA relative to what the fundamentals as we define them said it should be, then those are the places where house price declines were particularly dramatic. So this is a good, I think, statement about our model. We're picking it. We may not have the full list, but wow, when prices get ahead of themselves, ahead of what fundamentals might be, you can expect some serious declines. We got the ranking. We surely didn't capture the magnitude of it. I want to also, there's another way of capturing what's really different about this most recent bubble from the past. So again, we estimate our model for different time periods. If you went back to 1995 and you predicted what prices would be over the next few years, that's the one captured by the green, turquoise, whatever that is. Okay. So you see back then, even there was some sort of, on average, there was some pessimism about where things were going on average, but you had a pretty nice distribution, some places on the way up, some on the way down, or predicting to go down. 2001 to 2003, so this is just prior to the recession of 2000, that's this kind of reddish thing, and a little bit farther to the left, a little more pessimistic about where things are going, but a lot of distribution, a lot of variation in terms of what's going to happen at the metropolitan area. And then 2008 to 2010 is this bluish one, and you see now some of these tail events being much more prominent than ever before. So the model's picking up something, and this is one kind of way of capturing that, perhaps. Then the next picture shows what actually happened. And now I'm looking at the distribution across all those metropolitan areas. Again, the blue is what happened 2008 to 10, and it's just heavily skewed to the left. These are the places where you have dramatic declines. It wasn't just Stockton or Merced. There were a lot of places got hit really, really hard. In fact, there were only a couple of MSAs where there was a prediction, where a positive outcome. And one of the things Seth and I noticed, I'm from New Orleans, and there are a few places in western Louisiana and Texas where there was some really little change or slightly positive change. And just so happens, my cousin from Lafayette, Louisiana, was just with us for a couple weeks ago. And a lot of those places benefited from the when New Orleans was flooded by Katrina. There was this mass migration out of New Orleans into western Louisiana and parts of Texas, and those so happened to be the places where we got a little modest positive kick. Otherwise, most places around this country got hit much harder than they have in the last 30 years. Okay, the third question. So remember, we kind of hedged our bets a little bit in our measure of how prices compare to the fundamentals by including fixed effects. So there'd be a dummy variable in there for Stockton, something unique about Stockton that we can't capture. We estimated 350 or so of these fixed effects. And so we spent a lot of time looking at those fixed effects, did a lot of different things. We compared them to some of the Lincoln data on land, price of land and price of structure. We looked at various kinds of regulatory indexes. Turns out those fixed effects, which are kind of measuring how far prices are above the fundamentals on average over some long period of time, turns out that the places that got hit the hardest very highly correlated, where you had this kind of long run departure from the fundamentals. And so we've been scratching, what caused it, what led to that. A lot of urban regional economists talk about supply elasticities. So in areas where you have a tight regulatory environment where it's a little harder to build, maybe those are going to find prices above the fundamentals because the supply is restricted. And we looked at some really good work done at Wharton by Joe Giertz, where they estimate regulatory rules, and but only for 20 or 30 MSAs. I forget how many there were. So we looked at our fixed effects versus those regulatory indexes, and there in fact was a kind of a positive. It was capturing something about the local market regulations that really would, I think, lead you to do more analysis of that. Strong role for momentum, very consistent story. We were talking today about what's going on in China, right? There's a lot of positive growth going on in house prices, and if things were to turn around and you buy into this momentum model, things could go down pretty substantially. In the meantime, they just kind of keep rolling along. Wide variations among MSAs. We missed the worst outcomes for 2008 to 2010, and it's hard to predict extreme events. It's just one of my people that I read and study on this is a guy named Nicholas Taleb, wrote a book called Black Swan Blindness. And one of his stories is that economists have a difficult time predicting extreme events and are overconfident of our ability to estimate those extreme events. And this whole process the last 5-7 years resonated with me quite a bit, and written a little bit about that. This is consistent with that story, I think. It's a really solid, state-of-the-art model, and it's almost like we didn't see it coming. So next steps, we're searching for what did we miss? What were the variables at the local market conditions that could have done a better job if we had them incorporated in predicting what happened in 2008 to 2010? That's really our mission. And part one, task one, we're going to include more variables in our model and look to more quarterly data to pick up some of the dynamics. Like one of the variables we didn't include because we didn't have a long enough series was rent. We're going to look more at the role of mortgage originations and see if we can close that gap, come up with a better model of predicting what actually happened. And then task two is an even more deep dive at the period 2005 to 2010. And a big chunk of this is the American Community Survey. Any of you all use that or your data, right? So I've got the county data for 2005 through 2010, and you end up with about 650 counties where you can get. So we're going more granular, and ACS has a lot of different variables that we don't normally have in these kind of studies. Age distributions and things of that sort. So we're going to be searching. We'll estimate a similar kind of model, and we'll see whether we can find out more about the places that got hit particularly hard. Another way of phrasing it, we're going to see whether those fixed effects that were so prominent in the first study can be, we can shed some light on what was it about those MSAs that made them more vulnerable to this most recent crisis. And we've put together, I think, a phenomenal data set. HMDA, Home Mortgage Disclosure, ACS, Moody's Analytics provided us some data. And one particular part that I've been working on and will focus on here is the role of distressed real estate. So the standard story in, we talked about Cascade this morning, way the model of mortgage performance used to work, I'd say, until this most recent period. People have their mortgages, house prices start to decline. That puts more people with who are underwater, have negative equity. That leads to more delinquencies, more defaults. And then the banks come in and foreclose when at some point they're in default. And the property then becomes part of the bank's inventory of what we call REO, real estate owned. And at some point, they sell that real estate in the market, and the process ends. So it kind of starts with declining prices. It leads to delinquencies and defaults, and ultimately leads to foreclosures. So this is a friend of mine, that Mike Sklar's, has his own firm that creates data like this. So we're going to be spending a lot of time on that. I just did something recently for New York State. It's very complicated because of a lot of the laws are changing during this crisis. New York State has changed its law twice on judicial foreclosure processes. And you've all heard probably about this kind of de facto moratorium going on in foreclosures in many parts of the country as the attorney generals decide how to deal with this, and as HAMP and all those kind of things get put in place. So we think that is one area. There's a lot of evidence out there these days that shows where you have a lot of that distressed real estate, prices are much lower. One really interesting story, not to be my last one on this, but one paper recently looked at the price of a real estate owned sale relative to a regular sale. And I can tell you through 2005, the evidence on this was really powerful. I've done a lot, others have done a lot, like roughly 15%. So if a bank foreclosed on the property, they own it, then they sell it to an objective third party at the market price. Typically these REOs would sell for about 15% below what a non-distressed sale would look like. Maybe it's 20%, but it was very strong evidence on that. What we're finding now, and we're in the midst of this enormous data revolution, looking at zip code levels and things of that sort, you're finding that regular house price sales, non-distressed sales, are dramatically lower where you have a lot of distressed real estate. Vacancies, foreclosures, things of that sort, so much lower. But what some have found, this is the puzzling part, I think, the REO discount is still about 15%. And so the story is that the distressed real estate is bringing kind of average level of prices down, but that discount between REOs and regulars is staying about the same. Highly controversial new stuff, but that's the part we're going to be looking at. Thank you very, very much. How do you like our motivation? What are we missing is the number one question. We'd love to hear from you. And any literature, but thank you.
When you were describing the data for Stockton, I forget what the middle span of years, but when Stockton went way up, you said Stockton looked like a pretty good bet. I thought, the man is talking like a speculator. In fact, that kind of extreme rise in price, to me, if you're looking at that, look to see how much speculative activity is going on, and that would be a very good way to identify bubbles, is the level of speculative activity that's happening. I assume that you assume that real estate bubbles are not a good thing. They're something that we should prevent. In the introduction, I believe you've worked with tax policy. And so I'm wondering if you could look to tax policy as a way to possibly temper future bubbles, and whether you considered, whether you looked at property taxes and land value taxes and made that part of your data. It seemed to me that that was a missing piece that should have been in there, because I think that a good land value tax helps prevent speculative bubbles in real estate.
So a lot there. So let me just kind of, so I showed where in the 2001 or so, the model said next few years look pretty good. And so that momentum, that was reflecting a lot of that momentum stuff and things of that sort. Once things start turning around is when the flags go up a bit. And so in banking policy, that's one of the things they look at. Now, in terms of, we mentioned motivation. We motivated this by monetary policy. Kind of reflects my own biases recently. We talked this morning about, Seth and I are motivating it more by fiscal types of policies. A problem, a challenge, is getting a really good long-time data series on that. But this morning I gave them some new results in our, so I did kind of a really agnostic stepwise regression, looking at the places that got hit the hardest and which variables came in. And the property tax rate was like right up there near the top. So make sure you send me an email, lady. So it just, my jaw dropped, you know. And the part I'm working on property taxes in New York State, what I'm arguing there is house prices have gone down a lot, assessed values haven't. And so these effective tax rates, that's the angle I've been looking at. But there's something going on that we're going to be investigating. So thank you.
Obviously, the foreclosure rate got much worse because was much worse than it would have been if down payments had remained at 20% as they were for many years, and suddenly not suddenly, but when we went to a 5% down payment rate, there were lots more houses sold, but there were also lots more people on the margin. Do you think that there is a realistic possibility for changing the down payment amounts, in a serious, permanent way, and there would be lots of consequences to that?
So 2 points. The first, just on the role of the subprime crisis. Okay, and in this new project that we're doing, we've now collected data on from home mortgage disclosure that kind of highlights and measures the role of the subprime lending, and we have it at the county level. And I was just futzing around the other day and just in this exploratory part. And so here, this is a shocker, so sit down, please. The place that had the biggest declines in the last several years had the most subprime lending in like 2004, 5, and 6. Shocker? No? No, okay. I was going to write a memo to Ben. Say, Ben, look at it, Bernanke. But so it really, and we're going to try to do a better job on that. And then the what will the new world look like? There's huge debate going on about that, but I think there's two kind of avenues that people are looking into. One is to change the incentives for the lenders, so they've got to hold more capital in reserve for that, which would drive up lending costs and make it harder. And second, tougher underwriting criteria. We will see. Right now, FHA still gives very high LTV loans, and most of the loans now are FHA or Freddie and Fannie. We will see how that all evolves. I can tell you myself, I started in the 70s, and access to credit to minorities and low-income folks is pretty weak. And that was always kind of a reason I got into this stuff, to kind of promote it. And here you are in the early 2000s, it finally happens, and boom, just an utter disaster for many, many people. So I think there's going to be something like that. We'll see. We'll see. There was a settlement recently. I want to make a distinction of different kinds of fraud and law violations, but there was a settlement with option one. And there were some laws in in Massachusetts that have to do with a fair, unfair loan. So, for example, the judge ultimately ruled that if the initial debt-to-income ratio was 50%, your mortgage payment to income ratio is 50%, and you had an ARM with a adjustable rate mortgage, and the chance of a big increase in the trigger was 2% over the next few years. That was shown to be by the court unfair, and there's a settlement going on to that. Then there's the other issue about absolute fraud, right? One of the names applied to subprime loans in the literature is liar loans, right? Because what happened was they started using stated income and not documented income. And so there's a lot of work going on trying to sort that. A lot of this is part of the problem with the foreclosure moratorium. A lot of lawsuits going on, thinking whether the stated income was prudent, whether the appraisals were too high. And some of these folks, especially now, there's a lot of work going on about fraud on the HAMP program and things of that sort. It's a lot of these people, and the judge was telling me about some of the people who were coming forward to him and trying to get a modification. I said, God, you did a really good job of not giving them specific advice about whether they should, leave or whatever. And his point was, he said, these people are in such shock that it's hard for them to they can't even listen to really good advice. And my point is that a lot of the folks, when you're in this either euphoria or this down, they're more easily manipulated. So I'm sure there was fraud. We have no kind of consistent data to really do that, but I'm sure there was some of that going on.
Yeah, I just want to speak to the qualitative aspects that are harder to model, particularly using the Stockton and Modesto examples. They're the outer extreme of the Bay Area. The Bay Area is obviously San Jose, Oakland, San Francisco. The reason people moved to Stockton and Modesto was cheap housing prices. People wanted new construction, cheap housing prices, but they had none of the advantages of living closer in terms of transportation. It's way out there in terms of climate. It's totally different from the Bay Area. In terms of the physical beauty of the Bay Area, none of that is out there. So it's no surprise that as soon as people realize their 2-hour commute or whatever, that would just drop off. And so the question is, did you look at what happened in the other Central Bay Area cities and how that compared to that, versus like Memphis is isolated, whereas this is part of a greater and the qualitative aspects of it's really not a nice place to live versus the other.
Well, I went to UC Davis. Stockton was right down the road. A couple of things. I have another paper about real estate markets in declining cities, where Stockton was one of my case studies, kind of compared it to Cleveland. So I went into a lot more detail. Here, we didn't. But in this new task, we'll be at the county level, and you can be able to contrast what happened to Stockton or San Joaquin County relative to the other counties in the Bay Area. And another, I don't know if you call this qualitative, but an economist at the Fed recently talked about the impact of gasoline prices, because there are parts of Stockton MSA that are long distance commutes, right, into the East Bay and Fremont. Those kind of areas. My brother and his kids live in that area, and my nephew just bought renting this phenomenal house in the far distance of Contra Costa County, right on the border of San Joaquin. We're going to see, all else equal, the big rise in house prices would have killed that market quite a bit, right? That we didn't take that into. That's clearly part of it, and the kind of thing you need to get down more granular, geographically granular. I believe that's a possibility for sure. I would say one other thing. I was interviewed by the LA Times and the Merced newspaper because I was calling Stockton a new emerging declining city, and so they didn't like that too much. And but what they said was it's still much cheaper than the Bay Area, with kind of their right, yeah. Sorry. Even cheaper.
Current economic conditions are a lot weaker than the other time period slices that you looked at. Any intention in going all the way back to the 20s and 30s and taking a look there, or are the data obstacles too great to do that?
The world begins in a lot of this work with, it used to be called OFEO, and they started price indexes. There are a few MSAs in the late 70s, and then it really starts in 80. So that data, that's it. And these are weighted repeat sales indexes. Now, there are many case studies. In Schiller's book, he goes back to the 1920s. But then you focus on a particular metropolitan area. Like he did a lot of, he looked at New York, around the Great Depression and the stock market collapse. So you have to go that way. You would try to get longer time series about smaller numbers of places. But in ours, we couldn't go back any further than that.
Just building on the comment this fellow had here, it does seem like there probably is a spatial variable in here that would be worth looking at in terms of relationships to the locus of major employment within a metro area, which could be a conglomeration of MSAs in the case of the San Francisco region or the LA, something like that. That's one thought I had. Another thought I had is that maybe looking at some of the population characteristics, the types of people that live there, both ethnically and income-wise, or cross-section of those and other characteristics, who, for lack of a better term, might be considered easy marks for speculation, and don't have a good grasp of how the housing market works for family historical reasons. And the third question I had for you was, we look at that chart of MSAs that are really hit hard. We don't see ones in Texas, which was the case 20 years ago. And is there anything to be learned from comparing Texas to California, or Arizona, Nevada, Florida, that maybe there's something there, that another variable lurking in there to do probably with the way they regulate their banking markets?
So spatial, and the second one was population characteristics, and the third one was Texas.
Yeah.
There's a few things. I'll work backwards. So the definition of a stress scenario for the Freddie and Fannie until this period was what happened essentially to Texas in the Southwest in the early middle 80s. That was the worst historical experience in terms of mortgage defaults. And so what comes out of this work and other work Seth and I've done, what happened now just blew that away. And clearly what happened in there was related to the S&L crisis and the oil crisis as well. No doubt about it. So did regulation, that you're kind of leading, did regulation matter? So
that's why we didn't see this happen in Texas. There's a lot of similarities to some of the Sunbelt cities.
So I always kid Hong, I'm going to say Jim believes that, regulation really did matter and did do a very good job in a whole variety of dimensions. The stress test scenario is one, but one of the things, when I wrote some of my retrospectives on the most recent one, I'd be at Freddie or in the private sector estimating models and some of these teaser loans and the liar loans and things of that sort using really short data sets. They simply weren't around very long. Have you heard of the option arm? So you have like in your credit card, you can make a minimum payment or you can make an interest only or whatever you want. Well, the option arm that's where a lot of the damage was done in the last several years. Well, there was an option arm in the early 90s in the Bay Area. Great Western. Are you from the Bay Area? Yeah. So the Great Western was the big thing there, and they did option arms, and they did really well. But their clients were really wealthy people who tended to get paid on commission and end of year bonuses and things of that sort. But when you start bringing that into the areas where the option arms were being made in the last several years, it's exactly your point. There's something called reverse redlining. Have you heard of that story a bit? I mean, that's another angle on that. I hope that's going to change. As far as the social characteristics, we were talking about that this morning. Clearly, Kathleen Engel. Anybody know her? Professor over at Suffolk. She wrote a book called The Subprime Crisis. I've worked with her over the years, and a law professor. And I mean, her evidence is just overwhelming about how minority communities were harder hit. No, I think, and there are many others, but a lot of evidence on that. One of the interesting things in the HAMP program is that monitoring that fair lending in the new program is being stymied in a number of ways. Turns out getting a lot of data on race and ethnicity of some of the people going into it, to be able to do these statistical models and detect fair lending, pretty limited. And it's a real problem, and they're struggling with it, about how to do that. As far as the spatial goes, to me, the best way of thinking about this is to go even more granular, zip code or whatever. And there is some, I think, so I've learned a lot from Ed Colson at Penn State and some of these other spatial econometricians, and thinking about ways of doing that. Here, it would have to be, so we will have most of the counties within a large MSA, and so we can begin to look a little bit at that. The really nice article in Cityscape this last year or two, the HUD journal, that talks about ways of thinking about the spatial. So I think that's a really important issue, and whether we can tackle it is not such hard.
In terms of literature suggestions, Joe Giertz and Fernando Ferreira came out with a paper a couple months ago that is supportive evidence for some of what you're finding and is some good context. So they look at breakpoints, and they're trying to figure out what's the heterogeneity across MSAs in the beginning of the boom. And they look at how the coefficients on fundamentals like income, for example, change. And they found that income was really the only one that changed, and the other ones were remarkably stable. So then thinking about how they find income changing and you don't as much, it seems like the stability of your coefficients is also driven by the fact that you're not allowing them to change at the boom. You're estimating one coefficient for the entire sample. So that's still going to be driven by the fact that you're still, most of that is the 20 years between 1980 and 2000, or the 25 years. So if you interacted that coefficient with something like, after 2005, you might see some supportive evidence for what they're finding as well.
Thank you. And so I try to follow Joe's stuff, and he was at when I gave this paper at an institute in May, he was there. I'll make sure I see that one. Our story on the regime change, what we tried to do was estimate the model for different time periods. So in our Journal of Housing Economics paper, we also tried to start it at different times. So we looked at 1980 through 2007 or whatever, and then through 1995. And then we started in 1990 and went off there. Here we thought we would capture that by adding more data. So we do 1980 to 1995, 1980 to 2000, 1980 to 2007. And those coefficients weren't changing that much. So you added that information. But I think the regime change is a very challenging part. And I think we're going to pay more attention to that this time. And I'll check out that paper. So those guys do really good stuff, I think.
I'd like to follow up on the China thing. You said that the housing seems to be start to stable there. Actually, what about the bubble is starting to happen in Shanghai? They're overbuilt and prices are dropping, and they're having repercussions among people who bought their apartments and they bought their investment in real estate. And so much of the sovereign fund of China is based on property value that it's starting to crumble. We've just had a discussion in our office, as a matter of fact, part of the Euro mess that's going on right now. And how much China is there to bail out people. Everybody thinks everybody's going to go money. The money is just disappearing in China because they don't have it anymore. There's a lot of supposition that they do have it, but they really don't, and it's dropping in their own country. They're probably overbuilt here. Shanghai's one example. You've got other places where where cities have been built for over 1 million people and they're populated by 20,000. And this devalues the property value in China, which of course is underwriting everything else. and what is the domino effect of that? As a Californian, I know what the effect of Asian money has on the West Coast, and where they're starting to pull back. They're starting to say, hey, is this really going to happen? And it's just like in Greece, they're asking, when is the drachma coming back? We're asking in California, when are we going to start depending on ourselves? So,
A couple of comments. I was at the Fed a few weeks ago, and
One of the things I'm suggesting is this more micro-prudential policy, and they were telling me they just got back from a conference in China where they were starting to think in those areas. The second comment is, Greg and Hong know China. I don't know China. I tried to incorporate some of that literature survey into ours. Bubble formation in China. It was just millions of papers. It's unbelievable. So sorry, but these folks, these.
Okay, thank you very much.
Thank you.